For literally 6 decades, Warren Buffett was Berkshire Hathaway. I mean, the Oracle of Omaha was completely synonymous with value investing, patience, and that legendary strategy of just waiting for the fat pitch. But on January 1st, 2026, that era officially came to an end. Buffett stepped down as CEO, handing the keys to this trillion-dollar empire over to his hand-picked successor, Greg Abel. And while Buffett is still chairman, the true decider is now Abel. 8 months into this massive shift, the question is no longer if things are going to change. In this explainer, we're looking exactly at how he is completely rewriting the Berkshire playbook. Okay, let's dive into this.
Starting with one absolutely staggering number, $300 billion. That is the massive, unprecedented cash pile that Greg Abel inherited on day one. You know, in Buffett's later years, we saw this era of extreme cash hoarding as market valuations just climbed and climbed. But inheriting a mountain of cash like that, it sets incredibly high stakes for a new CEO. The whole market has been watching with a microscope, right? They want to see exactly how this transition from legendary patience to aggressive action is going to unfold. Abel didn't just inherit cash, he inherited the intense pressure to actually deploy it.
To really wrap our heads around this new era, we have to contrast their philosophies. The classic Buffett model, it was defined by patience, waiting years for that perfect fat pitch. And honestly, he was often perfectly content operating as a mere shareholder in a really great business. But Greg Abel's new blueprint favors aggressive deployment of capital and serious operational efficiency. And most importantly, as you'll see, he isn't settling for just a fraction of a business anymore. He wants full control. It's a fundamental, sweeping philosophical shift right from the very top.
Section 1. From shareholder to owner. Now, what's really interesting about this slide is how Abel is actively choosing to deploy that massive cash pile. He's no longer just buying partial shares, he is buying entire companies. Abel's philosophy is translating directly into rapid action. He is looking at that $300 billion and deciding, you know what, minority stakes just aren't enough. In the first half of 2026 alone, Abel orchestrated 2 huge full acquisitions. He bought Occidental's chemical arm, OxyChem, for $9.4 billion, and he took the home builder Taylor Morrison completely private in a $6.8 billion buyout. In a market where valuations are seriously stretched, Abel is buying the whole company to basically sidestep market volatility entirely. He is betting absolute billions on securing long-term, reliable cash flow over worrying about short-term stock price fluctuations.
Next up, the big portfolio overhaul. Because Abel isn't just buying full businesses, he is ruthlessly and quickly cleaning house when it comes to Berkshire's massive public stock portfolio.
And the biggest shockwave in all of this? Alphabet is now Berkshire's 3rd largest holding at a staggering $36.6 billion. Abel isn't just a casual fan of Google search and YouTube here. He is making a massive, highly concentrated bet on artificial intelligence. For Abel, Alphabet really represents his version of Buffett's legendary Apple investment. It's a virtual monopoly, equipped with a massive, absolutely undeniable future in AI.
Now, if you're wondering why he is so incredibly confident, 82% really tells the whole story. That is the year-over-year jump in Google Cloud revenue, and it is backed by a massive $514 billion backlog. So, this isn't just speculation or hype. This is hard, undeniable data showing incredible growth. Abel sees enterprise AI adoption happening in real time, and he has positioned Berkshire right at the absolute center of it.
But you know, to buy the future, sometimes you really have to sell the past. Over an aggressively paced 8-quarter streak, Abel has slashed Berkshire's position in Bank of America by 53%. I mean, this was once a beloved Buffett favorite, a true cornerstone of their financial portfolio. But Abel, he's just looking at the numbers without an ounce of sentimentality.
And this brilliantly illustrates the incredibly disciplined logic driving this slightly painful exit. See, Buffett originally bought into Bank of America when it was trading at a massive 62% discount to book value. It was the ultimate value play, right? But under Abel's watch, that exact same asset soared to a 64% premium. It simply became way too expensive to hold on to. It is a literal masterclass in disciplined portfolio management, knowing exactly when an asset has exceeded its intrinsic value, totally regardless of its deep history with the firm.
In that ruthlessness, it extends to smaller holdings too. Abel completely exited positions in absolute market giants, Visa, MasterCard, Amazon, and United Health. Gone. Why? Because to Greg Abel, if a position makes up less than 1% of the total portfolio, it's honestly just a distraction. He is aggressively cutting the dead weight so he can concentrate capital entirely into his absolute highest conviction winners.
It is a rapid acceleration of focus that we rarely, if ever, saw in the previous era.
Which brings us to the bull versus bear. An overhaul this aggressive doesn't happen without making some serious waves, and Wall Street is currently split right down the middle on this strategy.
Over on the bear side, you have loud, high-profile skeptics like Michael Burry pointing fingers. He famously stated, "The fear has come true, lacking patience for the fat pitch." The big worry here is that Apple is recklessly deploying all this cash into an already overvalued market, simply because that $300 billion is burning a hole in his pocket. Burry and others think he should be patiently waiting for a true macroeconomic crisis so he can buy at rock-bottom prices, like Buffett used to.
So how do these opposing views actually stack up against the data? Well, the skeptics immediately point to the stock performance. Berkshire is up roughly 4% year-to-date, which noticeably lags the S&P 500's 12.6% gain. The market is absolutely pricing in what they're calling an Abel discount. But the fundamentals tell a very different story. The bulls point to this huge shift toward operational efficiency and massive internal confidence, highlighted by Abel authorizing $4.5 billion in share buybacks in Q2 alone. Management clearly believes their own stock is remarkably cheap right now. So the crucial point is balancing that short-term stock lag against these really aggressive, confident internal moves.
And the absolute strongest argument for the bulls? $12.98 billion. That is the record Q2 operating earnings, up a stunning 16% and significantly beating market estimates. So despite the slightly lagging stock price, the underlying business engine of Berkshire Hathaway is literally firing on all cylinders. The operating businesses that Abel has meticulously organized are generating absolute mountains of cash as we speak.
And that leads us nicely into our final section, Abel's new Berkshire. Because the DNA of this entire company has fundamentally transformed from patience into aggressive concentration.
Let's move to and see how this builds on a classic piece of wisdom. Warren Buffett famously said, "Price is what you pay, value is what you get." Now, critics out there say Greg Abel is paying a very high price in today's stretched market, but look at what he is actually getting for that price: total operational control. He is pruning away the distractions. He is making massive, convicted bets on AI and housing. He isn't just sitting around waiting for the market to magically hand him value, he is actively out there constructing it himself.
So as you can see, this is absolutely no longer your grandfather's Berkshire Hathaway. It is faster, it's way more concentrated, and it is unapologetically aggressive. The whole financial world is watching closely to see if legendary patience is still a virtue or if it's just a relic of the past. One thing is for sure, Greg Abel is definitely doing this his way. So the only question left for us is, are you buying the new Berkshire strategy?